What are some of the best books for stock market investing? In this video, I'll be sharing with you the books that I believe will help you get started in the stock market. While I did not arrange these books in order of importance, I did, however, arrange these books in a strategic manner. And I'll be sharing with you along the video why I arranged these books in such a manner. So let's get started. The first book that I believe will help you get started in the stock market is this book by Tony Robbins called Money, Master the Game. Tony Robbins has this famous philosophy that is, model what works. He believes that success leaves clues, and in order for us to be successful, we do not need to reinvent the wheel, but rather we need to find people who have already achieved the success that we want to achieve and model what they have already done. In writing this book about money and investing, he wanted to find people who are already successful in this field and learn and model from them. So he went out to find these successful people and interviewed them. And some of these people that he managed to interview were Carl Icahn, David Swensen, Ray Dalio, Warren Buffett, Paul Tudor Jones, and Jack Bogle. That is an amazing lineup if you ask me. That is like playing fantasy league for investors. And the investor in me is geeking out at this lineup, right? But I digress. Tony Robbins went out to interview these successful people and compiled everything that he learned into the book Money, Master the Game. Before I started investing in the stock market, I had two options. The first option is to learn about investing and invest for myself. And the second option is pass along my money for someone else to help me invest. But I knew two things. The first is that money and my financial future is an essential part of my life. And I knew that I had to take control and personal responsibility for such an essential part of my life. And the second thing is this. No one cares more about your financial future than yourself. And this book, Money Master the Game, talks about the pros and cons of investing for yourself and passing money along to others for them to help you invest. And the main takeaway that I got from this book is this. 96% of actively managed funds fail to beat the market. So the market in this context is the index that tracks the US stock market, which is the S&P 500. So 96% of actively managed mutual funds fail to beat the S&P 500 over any sustained period of time. On top of that, by investing in the index, you don't have to pay a professional to try picking which stocks in the index you should own. And this was the biggest takeaway that I got from reading this book. Let's now take a closer look at why this book advocates investing for yourself rather than passing money along to others for them to help you invest. The first thing that we'll take a look at is the performance or the returns of the two. This is a page from the book Money Master Game. And in this page, they compare the average returns of investing in the index by yourself versus the average returns of you passing your money along to someone else to help you invest. So if you take a look at this page, they mention that over a 20-year period between 1993 to 2013, the S&P 500, which is the index, returns an average annual return of 9.28%. But on the other hand, the average mutual fund investor made just over 2.54%. So if you had choose to invest in the index, the S&P 500 by yourself, you have made an average annual returns of 9.28%. But on the other hand, if you chose to pass money along to someone else to help you invest, so in this case, passing money along to mutual funds to help you invest, you only achieve a return of 2.54%. So that is the difference between investing in an index fund by yourself versus passing money along to a mutual fund to help you invest. Now you might be wondering, since the S&P 500 or the index that you are investing in is averaging a higher return compared to a mutual fund, you might be forgiven for thinking that the fees associated with investing in the S&P 500 or the index is higher than the fees associated with investing in a mutual fund. But that is not true. This is another page from the book Money Master Game. And in this page, they talk about the fees associated with investing in the two. So the average cost of owning a mutual fund is 3.17% per year. On the other hand, the fees associated with investing in an index can be as little as 0.14%. In fact, I took a look at a more updated example. So this is an article by Investopedia. It mentions that the S&P 500 ETF or the SPY has an expense ratio of 0.095%. And while this ratio is low, the Vanguard S&P 500 ETF expense ratio is even lower at 0.04%. So what is an expense ratio? The expense ratio of a stock or asset fund is the total percentage of fund assets used for administrative, management, advertising, and all other expenses. So an expense ratio of 1% per annum means that each year, 1% of the fund's total assets will be used to cover expenses. While the average fees associated with investing in an index is less than 1%, the average fees associated with investing in a mutual fund is roughly 3%. If you think that the 2% difference in fee is not a lot over a year, you are correct. But chances are you are investing for longer than that. And this is where the fees really add up over the years. Let me show you an example. This is a page from the book Money Master Game. And in this chart, they talk about the impact of fees. In this example, we are taking a look at 1 million invested over 30 years and the different returns that are generated based on the different annual fees that are charged. After 30 years, with a 1% annual fee, your $1 million invested would become 7.6 million. And with a 2% annual fee, your $1 million invested would have become 5.7 million after 30 years. And with a 3% annual fee, your $1 million invested over 30 years would have resulted in 4.3 million. Take a look at the difference in the returns between the 1% annual fee and the 3% annual fee at the end of 30 years. The difference is more than $3 million. In fact, the returns from the 1% annual fee is 1.5 times more than the returns from the 3% annual fee. So while the 2% difference in annual fee might not seem like a lot at the start, but over time this can lead to a huge difference in the returns that you are able to generate. And I made a simple chart over here comparing the difference between investing in an index by yourself versus passing money along to other people to invest in mutual funds. And I compared them against two important criteria: returns and fees. In terms of returns, we have learned from the book that on average, investing in the S&P 500 or the index generates a higher returns than investing in a mutual fund. So in terms of returns, the index beats the mutual fund. And the next thing that I compare them against is in terms of fees. From examples from the book Money Master Game and from the article Investopedia, we learned that the fees associated with investing in an index is lower than the fees associated with investing in a mutual fund. Again, the index beats the mutual fund. So this book, Money Master the Game by Tony Robbins, really helped me decide on whether I wanted to invest for myself or pass along money for other people to invest for me. Now that I've decided to invest for myself, the next question is this: as much as possible, how do I invest only when the market is going up and stay out when the market is going down? And this led me to Ray Dalio's book, Big Debt Crisis. So we know that prices do not always rise, and when prices rise, they do not move up in a straight line. So prices tend to follow something like that, right? You'll go up, but you will fall down a bit, but you will continue to go up, fall down a bit, and then at the top, it reaches the top, and after that, it will start to decline. So when it declines, it falls like that, but it will go up a bit, falls, go up, falls, and after that, it continues again. So my question was this: as much as possible, how do I invest only when the market is going up? So at around this point here, so I would say around this point, and stay out when the market is going down. Avoid this point here to this point here. So how do I invest only at this point here and stay out at this point here? And Ray Dalio's book, Big Debt Crisis, provides some insights. While the book did not specifically mention when to enter and when to exit the stock market, it did, however, explain the bigger picture, or in Ray Dalio's words, the longer-term debt cycle. And the stock market repeatedly follows this cycle like clockwork. By understanding the bigger picture and the longer-term debt cycle, Ray Dalio believes that we are better able to navigate the big debt crisis, or this point over here. Why are debt cycles and debt crises inevitable? Ray Dalio explained that it's because lending is never done perfectly and is often done badly due to how the cycle affects people's psychology to produce bubbles and busts. So while policymakers generally try to get it right, more often than not they err on the side of being too loose with credit because the near-term rewards, faster growth, seem to justify it. It is also politically easier to allow easy credit than to have tight credit. And that is the main reason why we see big debt cycles. Why are cycles created? Let's take a look. Ray Dalio explained that a cycle is created anytime we borrow money. Buying something we can't afford means spending more than we make. We are not just borrowing from our lender, we are borrowing from our future self. So essentially, we are creating a time in the future in which we need to spend less than we make so we can pay it back. And this pattern of borrowing, spending more than we make, and then having to spend less than we make quickly resembles a cycle. Let me illustrate what he means by that. When we borrow, we can consume more now, so the cycle looks like that. However, when we borrow now, we can consume less later. So in the future, we will be able to consume less and the cycle looks like that. When we borrow more now, we can consume more now, and this corresponds to the rising part of the cycle. But at the same time, because we are borrowing more to consume more now, in the future, we have to spend less. And because we spend less in the future, we are able to consume less. And this corresponds to the declining part of the cycle. And this is how the cycle is formed. Therefore, by understanding how cycles work, we are better able to understand where we are in the cycle. And by having a clearer picture of where we are currently at in the cycle, we are better able to know when to stay in the market and when to stay out of the market. So that is what this book by Dalio is about. Okay, now that we know that we want to invest for ourselves and as much as possible when to stay in the market and when to stay out of the market, the next question that came into my mind was this: how do I achieve returns that beat the S&P 500 or the stock market as a whole? To do that, I had to pick individual stocks that could potentially beat the stock market index. And that led me to this book, The Intelligent Investor by Benjamin Graham. This book is like a Bible to value investors. And Warren Buffett, probably the best value investor out there, mentions that this is by far the best book on investing ever written. That is indeed high praise coming from Warren Buffett. When I picked up this book, I wanted to learn how to identify companies that could potentially beat the stock market index. And while there are many different strategies out there, this book provides one of this strategy. And the first thing that I learned from this book was this concept called the margin of safety. So what is a margin of safety? A margin of safety is the difference between the intrinsic value of a stock and its current stock price. So this difference between the intrinsic value of a stock and its current stock price is what we call margin of safety. And as investors, we ideally want to invest in companies with some margin of safety. So what this means is that when we are investing in companies, we ideally want to invest in companies whose intrinsic value is higher than its current stock price. So that is the first takeaway that I got from the book. The next takeaway that I got from the book is this: many investors are too focused on price. So if they see a great company that is slightly expensive, they might pass on the company. But if they see an average company that is slightly cheaper, then they will go for that company. That was the second takeaway that I got from this book. The book mentions that the risk of paying too high a price for good quality stocks while a real one is not the chief hazard confronting the average buyer of securities. Instead, the chief losses to investors come from the purchase of low quality securities at times of favorable business conditions. Right? So as investors, sometimes we tend to make this mistake. We may choose to avoid investing in great companies just because they're slightly more expensive. But we'll choose to invest in average companies just because they're slightly cheaper. And this was the second takeaway that I got from the book. Warren Buffett also mentioned that it's far better to buy a wonderful company at a fair price rather than a fair company at a wonderful price. The next book is also a book that better helps me identify companies which can potentially beat the S&P 500 or the stock market index. And the book is The Warren Buffett Way. So the first takeaway that I got from the book is also the margin of safety. The book mentions that calculating a company's economic future is imprecise and difficult to forecast. So we don't have to calculate the exact and precise intrinsic value of a company, but instead we want to get a rough gauge of a company's value and then make sure that the stock price is lower than that amount by a large enough margin, right? So that is what we call margin of safety. And the second takeaway that I got from this book is the limitations of buying cheap. So for example, if we paid $8 for a company whose value is $10, we will make a profit if the company appreciates on a timely basis. However, if the underlying economics of the company is poor and it takes 10 years to appreciate, then our total return is likely to be below average. So the lesson that I got from this point is this: while it's important to buy a company that is relatively cheap, and by cheap I mean its price relative to its value, which I mentioned in this video over here, where I mentioned the things to look out for before you invest in the stock market. Buying cheap is only one part of the equation. The second part of the equation that I believe is also equally important, if not more important, is buying a great company which has a higher probability of appreciating in a timely manner. So the first book, Money Master the Game, helped me shift my mindset and helped me decide once and for all that I wanted to invest for myself rather than passing money to other people to help me invest. And after deciding that I wanted to invest for myself, the second book, Big Debt Crisis, allows me to understand as much as possible when to stay in the market and when to stay out of the market. And after that, the third and the fourth book, The Intelligent Investor and the Warren Buffett Way, helps me to identify which stocks can potentially beat the stock market as a whole and the index. And I believe these are the best stock market investing books that will help you get started in the stock market. If you have liked this video, smash that like button because it will help the channel grow. And if you haven't already subscribed to my channel, make sure you subscribe to my channel because each week I release one new video about investing, trading, and the stock market. I'll see you in those videos to your financial success.